Hey everybody, in today's video I want to talk to you about something you should never do when you're trading, something that can cost you a lot of time and a lot of money, a trading strategy that seduces a lot of people and burns everybody all the time, so don't do this. What is the trading strategy? It's credit spreads. Now, if you don't know what credit spreads are, when you're trading options, you can buy a call or a put, or you can also buy a call spread or a put spread. Usually these are debit spreads where you'll buy a call and sell another call for a call spread, and the call that you're selling is cheaper than the call you're buying, so you have to pay what's called a net debit spread. Now, a credit spread is where you sell a call that's more expensive than the call that you buy. So you essentially get paid, so it's called a credit spread. Now, here's the problem. Just because you get paid for opening this credit spread doesn't mean that you just instantly made a profit. You have to put up collateral. And usually the collateral is many times more than what you're being paid. So for instance, if you open up a credit call spread where you sell an option that's $1, so you get $1 and then you sell another call that's even more out of the money for 50 cents, that you get a net credit of 50 cents. However, if that trade moves against you, you could lose anywhere from $1.50 to $2.50, so you have to put up anywhere from 3 to 5 times your money just in case it moves against you. So let's talk about what types of the most common types of credit spreads you have. You have what's known as a call put spread. So what a call put spread is, you will sell a put that's maybe a little bit out of the money, and then you'll buy another put that's even more out of the money, creating this spread. And what you're betting on is you're betting that whatever, if it's the S&P 500 or a stock, that it won't fall below a certain price. If it falls below a certain price, that spread then begins to move against you, and you have to cover the basically the put that you shorted. Now, let's say, for instance, you get 50 cents for that call spread credit, you would have to put up $1.50 to $2.50. For a credit. Now, for the other type of spread, what you call a bull put spread, basically that's, for a bear call spread, that's basically you're thinking that a stock or an index is not going to rise. So then you would sell short a call that's close to the money, and then you would buy a call that's more out of the money. And so you're thinking that this stock is not going to rise high enough. And it's the same principle as the bear call spread. If that stock moves too high too fast, you have to cover that call that you just shorted, and you could end up losing 3 to 5 times your money. Then there's also what's known as the Condor spread, where you're actually opening both a bear call spread and a bull put spread. So this is where you have, you don't think the market's going to move too high or move too low. You're basically betting on a market or a stock just to stay choppy or stay within a range. Now, here's the problem with this kind of strategy with credit spreads, is that people can become very successful with them. You can win 90% of your trades. So people are like, look, I can make 5 to 10% a month. And if you see a lot of newsletter services selling these credit spreads, they always advertise it as make 5 to 10% a month, win 90% of your trades. What a lot of these newsletters don't tell you is that when you lose the 10% of the trades you lose, you will lose 5 to 6 months worth of wins. So it actually ends up becoming a losing strategy, and it can really just drive you nuts that you have, for 5 months in a row, you make 5 to 10%. You're like, wow, my portfolio is up 25, 35, 45%. And all of a sudden you have this one loss that just completely wipes out all your gains. So credit spreads, put spreads, bear call spreads, Condor spreads, they're not they're not a strategy that you want to play around with. In fact, there's this saying on Wall Street that these kind of trades are known as collecting nickels in front of a steamroller. And if you can visualize that in your head, you could probably understand what I'm talking about. So avoid credit spreads. Never, the common sense thing here is never risk $5 to win $1. It's sort of like if you're in Las Vegas, they talk about people who gamble professionally. They don't bet on heavy favorites. Like if there's a horse that's a heavy favorite to win, you have to, lay $2 to win 20 cents. It's like, that's nuts. So if you ever hear the term credit spreads or Condor spreads, run away as quickly as you can. No one makes money off of them. The only people who make money off of them are people who sell newsletters selling credit spreads and Condor spreads, okay? Thanks. If you like this video, please like, share, subscribe, and I'll see you in the next video. Bye.